The broadcast is now starting. All attendees are in listen-only mode.
Good morning. This is Jeanette Stanziano with the New York State Association of Counties. Thank you for joining us this morning for our first in a series of virtual County Finance School webinars. Today we'll be discussing GASB accounting and updated information on that topic. Just a few pieces of important housekeeping for the program this morning. As you know, this program has the ability to earn a CPE credit. And in doing so, we have a few requirements that we'll be launching throughout the webinar that will basically substantiate your participation in this online program for the purposes of receiving credits. Please note that during the program, 3 silent polls will be launched. They're very simple questions that you will need to answer in order to be eligible for your credit. They're almost all just yes or no questions, but pay attention to your dashboard, and when you see a poll launched, please answer, and that will be our way of proving that you stayed throughout the program. At the conclusion of the webinar, a survey will launch that you will need to fill out. It's very brief. It's only a handful of questions. Again, it's part of the substantiating of your presence all the way to the end of the webinar as a virtual program. This webinar will be recorded and will be posted with a PDF of the slide deck at the NYSAC website at www.nysac.org/webinars if you want copies of this presentation. So I'd like to thank, first and foremost, the Office of the State Comptroller for participating in this program to allow us to credential this webinar today. Daniel Acalino of OSC has been working very hard to make this happen for us. So thank you, Mr. Acalino, and thank you, the Office of the State Comptroller, this morning. I'd like to introduce our 2 speakers from the Bonadio Group. Bonadio has been a long partner in NYSAC's trainings and often a participant at the County Finance School. We're happy to have Alan Walther and Heather Briggs, both principals and partners at the Bonadio Group. Alan is a partner at Bonadio's governmental division and leads its Albany office. For over 30 years, Alan has provided auditing, accounting, and consulting services to a variety of local governments, including counties, cities, towns, villages, school districts, community colleges, and public authorities. Alan has extensive experience with the application of GASB pronouncements, as well as the performance of audits under government auditing standards and the uniform guidance. Heather Briggs is a principal with the Bonadio Company. She works for the government division and for over decades worth of accounting and auditing experience has given her extensive knowledge in the audits of government agencies in accordance with uniform grant guidance, including counties, cities, universities, school districts, and public authorities, to name a few. Heather spent time as a school district treasurer in the Capital District before returning to public accounting. Ladies and gentlemen, I welcome representatives from the Bonadio Group.
Thanks, Jeanette, for the introduction, and thank you, NYSAC, for the opportunity to speak today. My email address is provided here as well. If any of the participants have any specific questions, feel free to email us with any questions that you may have. And I'll turn it over to Heather.
Jeanette, thank you. You gave a great introduction, and just like Alan, my contact information is here as well. If you have any questions, please feel free to reach out, and we'll make sure that we can answer any of the questions that you may have that we don't address today. So on our agenda for today, we're going to talk about some GASBs that will be effective very soon. GASB 95 came about in May, postponed some of the GASBs we're going to talk about today, including GASB 83, the certain asset retirement issues, GASB 84 related to fiduciary activities. Next slide. GASB 87 related to leases. GASB 88, disclosures related to debt, and 89, the accounting for interest costs incurred before the end of a construction period. Those are the items we're going to briefly discuss today.
So accounting standards, so this slide just describes what the accounting standards are that counties need to follow. Accounting standards are established by the GASB, which is the Governmental Accounting Standards Board. The Governmental Accounting Standards Board sets the accounting rules that all governments across the United States follow. It provides guidance as to reporting financial transactions in accordance with GAAP, GAAP being generally accepted accounting principles, and that allows financial statements prepared across the country to be consistent with their accounting treatments. GASB always has ongoing projects that are intended to improve and clarify the financial reporting process. As Heather mentioned previously, the GASB is up to GASB statement number 95, which was issued in early May. And our presentation this morning is meant to give the counties in New York State an update as to the significant GASB statements that will be needed to be implemented by them over the next couple of years in 2020, 2021, and 2022.
So GASB 95 came about in early May, I believe, of this year. During the COVID crisis, they decided to give us something to be happy about. I can actually say this is one GASB that maybe all of us actually like. It delayed or postponed the effective dates of some of the GASBs that were going to have to be implemented either in year 2019 or 20. One of those actually being 84 would have had to been implemented for December 31st, 2019. And for those of you that actually prepared your statements prior to the implementation of this GASB 95, you may have already implemented 84. However, those 83 through 93 at the top were delayed a year. And of course, 87 was delayed, postponed 18 months. So it gives us a little time to undertake 87, which could be very, very big project, and 84, of course, reviewing what's in your current trust and agency and determining, what would be fiduciary under 84.
So the first GASB that we'll talk about this morning is GASB 83, which pertains to certain asset retirement obligations. And this GASB, as Heather just mentioned, was delayed. The effective date is delayed until the periods beginning after June 15th, 2019. So that would be the current year, December 31st, 2020 for counties. And this GASB addresses reporting for certain asset retirement obligations, or AROs, and it's only would be applicable if you have a tangible asset retirement. Next slide. So an asset retirement obligation is a legally enforceable liability associated with the retirement of a tangible capital asset. Some examples that are given in the GASB of a tangible capital asset: a sewage plant, an X-ray machine, a nuclear reactor. Examples of assets that are not included under this GASB are landfills and pollution remediation. Both of those have separate GASBs that address the accounting for those obligations. Next slide, please. So the retirement of an asset is defined within the GASB as the permanent removal of an asset from service. And there are examples given of transactions that would trigger permanent removal: sale of an asset, abandonment, recycling, disposal are all examples of transactions that would trigger the permanent removal of an asset from service and the recording of an asset retirement obligation. So AROs are recognized when a liability is incurred and reasonably estimable, otherwise known as an obligating event. That's how it's defined within the GASB. And the GASB talks about internal obligating events, which some examples would be contamination of an asset causing it needed to be retired, abandonment, and then some examples of when assets are placed in service that they would have obligating events to take them out of service. They talked about windmills and that kind of thing. The other event would be external obligating event. And the examples given there are federal, state, or local laws that are passed that would cause an asset to be retired, contract provisions, or court orders. So when you have a asset retirement obligation, you recognize a liability and a deferred outflow based upon the estimated outflows that will be needed to retire the asset, and then over the estimated remaining useful life, you write off the deferred outflow against expense. And then the GASB also requires certain financial statement note disclosures to be provided, which include a description of the asset retirement obligation and the associated assets, right? So you describe what your obligation is and what the type of asset that is being retired is. You would describe the method and the assumptions used to measure the liabilities. So how you measured the estimated outflows that I spoke about previously. You would describe the estimated remaining useful life of the asset. That's the amount of time that it would be written off over. You would describe funding and assurance provisions, how they are met if that's applicable. You would describe the amount of assets, restricted pay liabilities. And if an asset retirement obligation has occurred but is not estimable, you would disclose that fact as well, that you have an obligation, but the dollar value cannot be determined.
So GASB 84, fiduciary activities, is to improve the identification of fiduciary activities. And again, with 95, this one was also delayed. It's effective for years beginning after December 15th, 19. And so for the counties, it's going to be effective for your December 31st, 2020 year end. However, there could be a few that were issued, financial statements were issued prior to GASB 95, and you may have implemented 84 already. There's 4 types of fiduciary funds to report: pension trust funds, investment trust funds. Here in New York, I think they're going to be less common than the private purpose trust funds, which, you know, we've kind of always been reporting. I don't believe that they change significantly, but the new custodial funds is where you're going to find a majority of your change, evaluating everything in your trust and agency fund currently to determine whether it is a fiduciary activity and where it actually belongs, whether in your governmental business type funds or in that new custodial fund. When you're identifying fiduciary activities, you're going to look to see, is it a fiduciary component unit? For the most part, those are pensions and OPEBs within a trust. We don't tend to typically have many of those, but if you did, it would you would have to evaluate whether, you know, the primary government has a benefit or burden, whether or not the plan is financially dependent on the primary government. Are they legally obligated to make contributions? So, you know, it would be a little bit of evaluation if such things existed. But for the most part, we're going to see this other fiduciary activities. That's, you know, evaluating things that you could possibly have control over. Is it derived from own source revenue? And that's going to be the items that you normally see, and you're going to have to evaluate in your trust and agency fund to determine, you know, where does this belong? Do we have control? Who's it for? Is it for the benefit of others? And is it really from our own source revenues? In March of 2020, OSC provided a memo on fiduciary activities, and there was this really nice checklist that was issued within it. It kind of helps you determine in where things are going to be reported. And if you go through this checklist with the items that you have currently in your fiduciary funds, it should point you in the right direction. In number 13, 14, or 15, what would be reported where. And if you're not really sure, you know, you can reach out to your accountant and auditor and get their involvement in this as well. But it's a good starting point to give you a little bit of insight on what you have and where it might go. So what does this mean for some counties around the state? What items could be part of the new custodial fund? A lot of counties may have SSI and welfare trust payments that they hold for others, mortgage tax payments that are owed to other municipalities, bail deposits, jail inmate accounts. Those are some items that you're going to want to evaluate and determine, will these stay in the custodial fund? They're not own source revenues. Yes, they are fiduciary fund amounts. Things that could be part of your general fund. You're going to move your payroll tax liabilities over. For items that are off the books accounts or any departmental cash that you do have in your agency funds, you're going to want to evaluate where those funds come from. You want to think, is it own source revenue? Do I have control? What are these funds? And that's going to take a significant amount of time if you have a significant amount of accounts within your trust and agency fund. The private purpose trust fund will basically stay unchanged. So what are the reports going to look like in your state, in your fiduciary activities? You're going to have a statement of fiduciary net position. That's going to report your assets, your deferred outflows, liabilities, deferred inflows, and net position. And then you're going to have your statement of changes in fiduciary net position, which is going to talk to your additions by source and your deductions by type. It's basically going to be a full accrual statement giving all information. So it's going to look a little different than what your trust and agency looks like with just your assets and liabilities. That's no longer applicable. You're now going to have revenues and expenditures reported for all your fiduciary activities.
Next slide. Thank you. GASB 87 pertaining to leases, as Heather mentioned initially, GASB 95, which was implemented in early May, delayed the effective date for GASB 87 by 18 months. All the other GASBs were delayed by 12 months. So the new effective date is for periods beginning after June 15th, 2021, which would be December 31st, 22 for counties. So the purpose of this GASB is meant to improve the accounting and financial reporting of leases by governments. It requires the recognition of certain lease assets and liabilities for leases that were previously classified as operating leases. Those would be leases that extend greater than 1 year. A lessee is required to record a lease liability and a lease asset unless it's a short-term lease, and a short-term lease is defined as less than 1 year. And then a lessor is required to record a lease receivable and a deferred inflow of resources. So it's different than how the accounting is done presently. A lot of information to gather the data that for all the leases that the county may be involved in, and evaluate them and understand how the new GASB needs to be implemented. And I think that is the reasoning why the GASB decided to defer the implementation for 18 months. So you have until December 31st, 2022 to implement this for your financial statements. So the next slide provides the definition of a lease that's within the GASB. And a lease is defined as a contract that conveys the right to use an other entity's non-financial asset as specified in the contract for a period of time in an exchange or exchange-like transaction. And the examples that are given within the GASB of a non-financial asset are land, vehicles, buildings, and equipment. So those are the types of assets that we typically see as auditors that our clients are leasing presently. Any contract that meets the above definition falls under the scope of GASB 87 unless it's specifically excluded. And on the next slide, the GASB gives some examples of asset types that are specifically excluded from the GASB. Intangible assets. Some of the examples given of intangibles were mineral rights, films, video, copyrights, trademarks, that kind of thing. Biological assets, timber, the county may have a forest, that kind of thing, or live animals. I can't think of any counties that own live animals, but that was given as an example within the GASB. Inventory, service concession arrangements, there's a separate GASB that speaks to that. and then assets financed with outstanding conduit debt, unless both the asset and debt are reported by the lessor, and supply contracts. All of those type leases are excluded. The lease term is defined as the period during which a lessee has a non-cancelable right to use an underlying asset plus periods covered by a lessee's or lessor's option to extend the lease if it is reasonably certain that the option will be taken, right? So if you enter into a lease and you believe that you're going to extend it, you look at that period, including the extension, and then periods covered by a lessor's or lessor's option to terminate the lease if it's reasonably certain that the option will not be taken. So you look and you consider whether or not you will terminate it early to determine your lease term. Short-term leases are defined as leases that at the start of the lease term, the maximum possible term under the contract is 12 months or less. So the payments here are recorded as expenditures for lessees. No liability or asset is recorded. The receipts are recorded as revenues for lessors. No receivable or deferred inflow of resources recorded. So this, or the accounting for a short-term lease, this is probably the way that you're accounting for them. If you have short-term leases right now, if you're leasing an asset, you're probably showing it as an expenditure. If you're acting as a lessor, you're probably showing it as revenue. So there's probably no change to your current accounting methodology for short-term leases, but the GASB does go through and define how the accounting should be handled for short-term leases as well. So the next slide is an example of lessee accounting. So if you are leasing an asset, so the initial reporting, the lessee should recognize a lease asset and a lease liability at the start of the term. So the debit is an intangible asset, the right to use, and the credit is a lease liability. And then the next slide, the subsequent reporting, the lessee should reduce the liability as payments are made and also recognize an expenditure for interest. So if you look at the bottom of the slide there, you can see the debits and credits. As the cash is paid, cash is credited, interest expense debited, lease liability debited, and then the lessee would amortize the asset over the shorter of the lease term or the useful life of the underlying asset. That's how you would recognize the expense. You debit amortization, credit intangible asset, right to use. The lessee accounting requires some, GASB 87 requires some notes to the financial statements, some financial statement disclosures, description of the leasing arrangements. You would disclose the total amount of leased assets by class, right? Building, equipment, vehicles, and related accumulated amortization. You would disclose the amount of outflows recognized in the reporting period for variable payments and other payments not previously included in the measurement of the lease liability. You would disclose principal and interest requirements to maturity, commitments under the leases, and components of any net impairment loss recognized on the lease asset during the period. The next slide is some of the debits and credits as to how you account for transactions where the county is acting as the lessor, where you are leasing an asset to others. So your initial reporting, the lessee would recognize a lease receivable and a deferred inflow of resources. The lease receivable measured at the present value of payments, deferred inflow measured at the value of the receivable plus payments made to the lessor at or before the start of the lease, and certain direct costs. And then subsequently, the lessor, the next slide, please. The lessor would reduce the receivable as payments are collected. So you would debit cash, credit interest revenue, credit lease receivable, and then the lessor would recognize revenue over the lease term, which is the second entry, debiting the deferred inflows, so amortizing deferred inflows and recognizing lease revenue as the term progresses. And then the next slide, there are also notes to the financial statements to be provided when the county is acting as a lessor. You would describe the leasing arrangements. You would describe the amount of inflows recognized in the reporting from leases. If that amount cannot be determined based on amounts displayed on the face of the financial statements, you would describe the amount of inflows recognized in the reporting period, and you would describe the existence, terms, and conditions of options by the lessee to terminate the lease or abate payments if the lessor government has issued debt for which the principal and interest payments are secured by these payments.
Okay, GASB 88 relates to certain disclosures related to debt. And here the purpose is to improve the consistency in the information that is disclosed in the notes to the governmental financial statements related to debt, including debt borrowings and direct placements. And it's going to provide statement users with additional essential information about debt. So it's a lot more disclosure information than anything. And again, this is a delayed GASB, so it is now effective for the counties December 31st of 2020. So what is the definition of debt for purposes of this disclosure? It's a liability that arises from a contractual obligation to pay cash in one or more payments to settle an amount that is fixed at the date the contractual obligation is established. I guess the key word there would be payments that are fixed at the date it's obligated. And for disclosure purposes, debt does not include leases, except for those contracts reported as finance purchase, and they do not include accounts payable. So what are the certain disclosures that we're going to need? You're going to have to disclose the information about unused lines of credit, if you have any assets pledged as collateral for debt, and if you have any specific terms in your debt agreements related to events of default that have finance-related consequences, termination events with finance-related consequences, and if there's any subjective acceleration causes within your debt arrangements, all those items will now need to be disclosed related to those items that are actually long-term debt.
GASB 89 is accounting for interest costs incurred before the end of a construction period. The purpose of this GASB is to enhance the relevance and comparability of information about capital assets and the cost of borrowing for a reporting period. This GASB was also deferred by GASB 95 for a year, so it is now effective for periods beginning after December 15th, 2020, or the year ending December 31st, 2021 for counties. So under GASB 89, interest incurred during the period of construction does not have a present service capacity, and therefore it was determined that it should not be capitalized. So that the GASB 89 requires that interest costs incurred before the end of a construction period be recognized as an expense in the period in which the cost is incurred for financial statements prepared using the economic resources measurement focus. That would be government-wide financial statements and business type funds. So as a result, interest costs incurred before the end of a construction period will not be included in the historical cost of a capital asset reported in a business type activity or enterprise fund. Okay, so you will not capitalize the interest. And then the next slide, GASB 89 reiterates that in financial statements prepared using the current financial resources measurement focus, which would be your fund level financial statements, interest costs incurred before the end of a construction period should be recognized as an expenditure on a basis consistent with governmental fund accounting principles, which is generally recognized within the funds as you pay the interest. So that I don't think there would be any changes to the typical way that county would recognize payments on their interest payments on their debt. So those GASBs that Heather and I spoke about were the GASBs that we had identified would be most likely to have an impact on our county clients. Other GASBs that are outstanding and to be implemented by governments, again, if they're applicable, GASB 94, which pertains to public-private and public-public partnerships and availability payment arrangements, that would be implemented for December 2023. GASB 93, related to the replacement of interbank offered rates, was delayed by the GASB 95 to December 22. GASB 92, which was an omnibus 2020, was delayed by GASB 95 and has various implementation dates. GASB 91, conduit debt obligations, delayed by GASB 95 to December 23. And then finally, GASB 90, majority equity interests, delayed by GASB 95 to December 31st, 2021. So those other GASBs, again, just keep them in mind as you're preparing your financial statements and implement if applicable.
Okay, we just launched our third and final poll that is part of the certification process. Please note that at the conclusion of the webinar, a survey will pop up that if you're seeking CPE credits, you must fill out. I think that's it for, I don't think we have any questions. If you have any questions, you can submit them through the dashboard. And Alan and Heather would be happy to answer any incoming questions. Just submit it in writing through the dashboard, and we will pass that on. The slides for this program will be available after the program in a PDF format on the NYSEC website under webinars. If you go to www.nysac.org/webinars, you will find the slides and the recording. These will be posted within about an hour of the conclusion of the webinar. Right now, I don't see any applicable questions other than whether or not the slides would be available. So I want to thank Alan Walther and Heather Briggs from the Bonadio Group, their insightful presentation this morning. We appreciate your time, and we appreciate the time of all of our attendees who are seeking CPEs. Thank you to the Office of the State Comptroller and Dan Accolino for helping us set up this program. There will be another program on Albany Update, which will happen on June 18th at 10 a.m. will be our next program for certification. And there will be 2 more following that presentation in the following week. So if you look at the NYSEC website under webinars, you will find the whole series of finance school virtual webinars. Thank you for joining us today. Have a great day.